Hello and welcome to another chapter on US taxation. So today we are going to talk about the concept of tax credits. Now that we have clearly understood how standard deduction and itemized deduction help to reduce the taxable income, let us understand and take a step further to the tax calculation journey. Because even after applying the deduction, we still arrive at a tax liability. We still arrive at a tax liability that actual amounts to tax we owe. And this is where things get even more interesting. What if I've told you that there are provisions that don't just reduce your income but directly reduce your tax dollar for dollar? That's exactly what tax credit do. Unlike the deduction, which works in the background by lowering the income, tax credit act as the final stage, which means that they are a kind of the deductions to the actual tax liability, directly cutting your taxes that are going to be paid to the federal government. So in this chapter, we are going to explore one of the most powerful tool in the taxation, which is tax credits, and how they can significantly impact a taxpayer's final outgoing. So let's start this chapter by looking at the agenda. Okay, so the key agenda that we're going to cover today is introduction to the tax credits. We'll talk about various tax credits that are available to an individual, key individual tax credits that are specifically available to the individual, and some of the tax credits that are available to the business as well. What is the eligibility criteria for these tax credit, and then how we have to calculate the tax credit. Concept of refundable versus non-refundable, and we understand a bit more that what this actually means. Some of the common errors which normally being committed by the taxpayers and some of the compliance risks to which they are exposed when they commit the errors. Some of the recent update and changes that has impacted the tax credit, and we'll quickly understand the entire concept of tax credit with the help of the detailed example, and then a quick synopsis of what we have learned in this chapter. We are going to look at that in the key takeaways slide. So let's start the discussion by understanding the tax credits. Okay, now we'll understand what is tax credit. So tax credit is the direct reduction in the amount of the tax a taxpayer owes. So unlike the deduction that reduce your taxable income, tax credit actually is being applied once you have calculated the tax. So which means that it is impacting your tax liability and reducing your tax liability dollar by dollar. Which means that this tax credit is designed to provide the financial relief to the taxpayer and encourage the specific behavior like the tax credit are available in the form of the education tax credit or child tax credit or some of the credits that are specific to some of the philanthropic purpose or other purpose for which the benefit is going to accrue to the nation. So why this matter? Because the tax credits can actually reduce your tax to zero, reduce your tax, and it may also trigger the refund, depending upon the type of the credit that we are going to avail. Because some credits actually helps us to get the refund, and while some credit does not give us refund, but it will if my tax credit are more than my tax liability, then it makes the tax liability zero. Tax credit versus tax deduction, we have given a quick bifurcation here just to make sure that how it impact. So deductions are largely reduces the taxable income, but the tax credit is the amount that reduce my tax liability itself. It's the benefit dollar to dollar. It depends upon the tax rate, and then tax credit is actually the actual benefit that is saved. For example, if there's 1,000 is tax credit, that is the thousand of the tax that we have saved. But unlike deduction, if we have 1,000 deduction, it is only going to reduce our taxable income on which tax will be calculated. So typically there are three type of tax credits. One is the non-refundable tax credit, which is that it is limited to the tax liability. So if my tax liability is less and my tax credit is more, then I can only adjust the tax credit to the extent of my tax liability. Second is the refundable tax credit, which means that if my tax liability is less and my tax credit is more, so excess tax credit will be treated as a refund and which will be given back to the taxpayer. and then partially refunded taxes, which is the combination of the both. We are going to discuss all these in the upcoming slides. Tax credit applies to the individuals and to the businesses. Individuals is family, students, low income earners, and businesses are R&D, hiring, hiring incentive, energy efficiency. And the key characteristics are these are claimed after calculating the tax liability subject to the eligibility and the conditions of the income phased out. Because income phased out limits are applied while giving the tax credit to the individual and may require the supporting documentation. So we'll move to the next slide and look at some of the other information on the tax credit. Okay, having understood the conceptual meaning of tax credit, we are going to discuss upon the type of the tax credit and see that what are the various type of the tax credits are available, and then how it actually helps to reduce my to reduce the tax liability of the taxpayer. So we will talk about some of the further understanding of the tax credit first. Classification of the tax credit. So tax credit are broadly classified into three categories. So we discussed that in the opening slide as well. Non-refundable tax credit, refundable tax credit, and the partially refundable tax credit. What are the non-refundable tax credit? So non-refundable tax credit can reduce the tax liability only up to zero. So which means that as I briefed in the previous slide as well, if my tax liability is more than my tax credit, tax liability is less than my tax credit, then the excess tax credit will not be refundable. It can only reduce the tax liability to zero. So which means that no refund is given for the excess credit. Formula is that tax payable is equal to maximum of zero or the tax liability minus credit. So what are the example of these type of credits are child and dependent care credit and the lifetime learning credit. So these are like credit which reduces your tax liability subject to the maximum of the tax liability. So if my tax liability is 2000, credit is 2500, final tax is zero because extra 500 is lost. I cannot get any refund because I have a tax credit which is more than my tax liability. Second important category is the refundable tax credit, which means that can reduce the tax liability below zero, which means that excess amount is refunded to the taxpayer. Formula is that credit minus tax liability. If credit increases my tax liability, then there's a refund which will be given back to the taxpayer. Examples are the earned income tax credit and the additional child tax credits. What are the example here? So well, let's say tax liability is 1000, credit is 2500, tax payable is zero, and the refund would be which is 1000 minus 2500. We'll get the refund. So we understood that for child tax credit, additional child tax credit, and the earned income tax credit, we have a refund. But for the child and the dependent care credit and the lifetime credit, we do not have a refund because we can maximum get the benefit to reduce my tax liability to zero. Let's move to the next slide and see a few more type of the tax credits. Now the third type is partially refundable tax credit, which means that a portion is non-refundable and balance is refundable. So example, American Opportunity Tax Credits (AOTC), 40% is refundable subject to the limits. For example, if a credit is 2500, refundable portion is only 100,000. Even no tax liability, refund allowed would be 1000. So this is how a particular tax credit is being applied to the three broad classification, which is refundable, non-refundable, and the partially refundable. Now, non-refundable tax credit reduces the tax to zero. Refundable tax credit also reduces the tax to zero, and partially refundable can also reduce the tax to zero. Refund beyond zero is not available for non-refundable. Refundable it is yes, and partially refundable it is limited. Risk of losing the benefit is very high because if my tax credit is more than my tax liability, then I will lose the entire balance of the tax credit. Refundable it is none, and partially refundable is moderate because only certain percentages allowed to be get as a refund, and it is subject to the limit. Now, key decision insights is low income taxpayer benefit more than the refundable tax from refundable tax credit. Higher income taxpayer often utilize non-refundable tax credit, and planning focus would be to maximize the refundable component. Not all the tax credits are equal. Refundable tax credits are the most beneficial because they can generate a refund even when no tax is owed. And non-refundable credit, on the other hand, are limited to the tax liability, making the planning crucial to avoid losing the benefit. So it has to be very planned, planned very meticulously just to make sure that if at all we are going to get the refund, then we are going to plan the credits in such a way that we can avail the benefit for the refundable tax credit. But if at all we are getting the non-refundable tax credit, that we have to we need to make up our mind that we are not going to get any benefit if my tax credit is more than my tax liability. So we'll move to the next slide. Now we'll talk about some of the key credits that are available to an individual and understand that how these credits are being applied. So key individual tax credits are designed to provide the financial relief to taxpayer to support the family, education, and the low income earners. First one is a child tax credit, which is like up to 2000 per qualifying child, up to 1600 refundable additional child tax credit. So the original is not being refundable, but the additional child tax credit is refundable to the extent of $1600 per additional child. A child must be under the age of 17 and claimed as a dependent, subject to the income phased out. Second credit is the earned income tax credit for low or the moderate income working individuals. Credit amount depends upon the income level, filing status, and the number of the children, which is fully or largely refundable. So, which is like earned income tax credit. Next is American Opportunity Tax Credit, which is AOTC, which is maximum credit is 2500 per student, which covers the tuition and the courses material. And we understood that 40% of it is refundable up to the, which is like 40% of 2500, which is 1000. Available to first 4 year of the higher education. So all these tax credits are subject to various conditions. We are going to learn them separately in the upcoming sessions, but in this session we are largely going to cover the entire concept of tax credit. We'll move to next slide and see what are the other credits that are available to the individual. Okay, so another type of tax credit that is available to an individual is the child and the dependent care credit, which covers the children expenses for working parents. Credit is 20% to 35% of the qualifying expenses which has been incurred to take care of the child and the dependent tax credit, and it is a non-refundable tax credit and helps the taxpayer to work or look for the work. Now, if we look at the quick synopsis of the various tax credits that are available to an individual is, first is the child tax credit, which is like 2000 per child, which is the maximum benefit. It is partially refundable family support. EITC, it depend upon the benefit varies, and refundable is fully refundable, low income workers. AOTC is 2500, partial refundable. LLC is 2000, which is like not refundable, and then dependent care is percentage base, which is not refundable. So these are the list of the credits that are available to the individual, and these are all dependent upon the income threshold and the phase out, because these limits do apply here. Filing status is single, married, etc. And then dependency rules are applied, and then a valid SSN requirement is there for some of the credit. So we'll move to the next slide and understand some of the more concept on the tax credits. Okay, now we'll talk about the credits that are available for the business. And what are those? So business tax credits are incentive provided to encourage the investment and innovation and the employment, and promote the economic growth and the sustainability, which reduces the overall tax liability to the business. And if we look at the key credits that are available to business are R&D tax credit, research and development tax credit, encourages innovation and the technological advancement, which is applicable on the wages for the R&D employees. Supplies used in research, contract research expenses, and available to the startups and the established businesses. Second is the work opportunity tax credit, which is WOTC. Incentives for hiring the individual for the target group, such as the veterans, long-term unemployed, ex-felons, and credit based on the wages paid and the working hours worked. And third one is the energy efficient green credit, which is the for investment in the renewable energy, solar, wind, energy efficient equipment. Examples: investment tax credit and the energy efficient commercial property. So all these credits are available on some of the business, like R&D is available to the startups and the established business. A work opportunity tax credit is available to the target groups such as veterans, long-term unemployed, etc. And the energy efficient green credit is available to the renewable energy to promote the spendings on the renewable energy and the energy efficient equipment. So we'll move to the next slide and look at some of the other credits which are available to the business. So another credit is small business health care tax credit. So basically, this is available for small employees, providing the health insurance eligibility. Small employees, small employers, sorry, providing the health insurance, which eligibility is the fewer than 25 full-time employees and average wages below threshold. Credit up to 50% of the premium paid. This is to make sure that the health of the employees which is being hired by small businesses are protected. This disabled access credit helps the small business to cover the cost of accessibility improvement and the ADA compliances, covers the ramps, signage, modified equipments. And then these are the credits which is available to the business houses to promote some of the energy segment or some of the specific area in which investments is required. And the eligibility criteria is must incur the qualified business expenses for the purpose for which it is destined, maintain the proper documentation so that support is available to claim the deductions from the tax payable, meet the specific IRS guidelines and subject to the limits and the carry forward provision. Utilization and limitation, most business credits are non-refundable, which means that the credit is not going to uh, generate the refund if the credit is more and payable liability is less, then the amount which is more cannot be generated any refund, but it will be set off and carry forward to the future year, can be carried forward back to the Australian next tax year, but limited by the business tax liability and the specific credit cap. So which means that if tax payable is less and credit is more, the excess would be carried forward. So we move to the next slide. Okay, now we'll understand the eligibility criteria. We understood that in the US, the major eligibility criteria to claim any kind of deduction or for that matter tax credit is the filing status. And then we have some phased out limits, and then we'll also understand some of the requirements basis which the credit is available if somebody wants to avail the credit on the dependent. We'll understand that eligibility criteria one by one. So first is the filing status. Must use an eligible filing status, single, married, filing jointly, or the head of the household. Some credits are restricted or reduced for married filing separately that are not available or their benefit is reduced. Second is the income limit, which is the phase out rules. Many credits have income threshold. Credit amount reduces as income increases. So, which means that this is the phase out limit, the credit amount reduces and it is applied on the because the benefit of credit is to give benefit to the lower income group. And if somebody is earning on the higher, then the benefit is also going to get reduced. For example, child tax credit begins to phase out at the higher income level. Third is the dependency requirement for credit like child tax credit and the dependent care credit. They must have the qualifying dependents, which is then subject to the relationship test, age criteria, residency requirement, and the support test. Then obviously the taxpayer should have valid the social security number to claim the benefit of the tax credit and taxpayer identification number wherever applicable. Earned income requirements. Some credits requires earned income such as earned income tax credit EITC. Passive income interest dividend may not qualify for the benefit of the EITC because it is specifically on the earned income which is being earned during the year like salary, wages or for that matter self-employed as well. And if somebody is earning the passive income in the form of the dividend interest or rent, then they will not be treated as they will not be treated as the income on which the earned tax credit can be claimed. So we'll move to the next slide and look at some of the additional eligibility criteria. Specific expense requirements. So this is largely for the business tax credit, wherein certain credit requires the qualified expense such as the education expenses or childcare, and for that matter, for business tax credit also, whenever the credit is being available, the it has to spend for the specific purpose for which it has been allotted for. And then we have to have the documentation and the all the documentation compliance needs to be maintained to make sure that we can claim the right amount of the tax credit. And other restrictions are cannot claim deductions if credit if already claimed by the other taxpayer, filing status disqualifies eligibility, and special rules apply for the dependent students and the non-residents. So we also understood that there are special rule applies to the dependents to claim the standard deduction as well in the last chapter of standard. Likewise, the separate rules apply to the dependent students and the non-residents. So typically, tax credits eligibility criteria are some of the criteria basis which an individual or a business house can avail the tax credit. And if they want to avail the tax credit, then they have to pass certain eligibility test. So we'll move to the next slide. Now we're going to talk about very important concept that how the tax credits are actually calculated. So we'll discuss this step by step. So tax credits are applied after computing the tax liability. This is the most important thing, and because it directly reduces the final tax payable. So calculation involved determining the eligibility first, computation of the tax credit, and then applying the limitation, which is the phase out cap. So first is to step is to calculation. The process is to compute the taxable income. So gross income minus adjusted and deduction arrive at a taxable income. We have to calculate the tax liability, which means that apply the tax rates based on the tax bracket. Then we have to determine the total tax before the credit, and then identify the applicable tax credit like child tax credit, education tax credit, EITC credit, and apply for the non-refundable credits. So reduce the tax liability up to the zero only. Formalize that remaining tax liability is equal to maximum of the zero tax liability minus non-refundable tax credit. Then we'll apply the refundable credit because if we apply the refundable credit first, then our entire credit would be exhausted in that year. Therefore, it is always advisable to apply the non-refundable credit so that we can take the maximum benefit. And then whatever refundable credit can are there, we are going to get the refund for that. Applied after non-refundable credits are applied for there, and then can reduce the tax below the zero, generate the refund. Refund is equal to refundable credit minus the remaining tax if positive. Step 6 is the adjust for the phased out amount limit, reduce the credit if the income exceeds the threshold, apply the maximum caps and the percentage limit. And this is how we're going to calculate the tax credit. We move to the next slide and look at the other aspect of calculation of the tax credit. Okay. So if we look at the flow, how it flows, tax liability is there. We have to calculate the non-refundable tax credit, then refundable tax credit, and then the final tax. So we have give a quick example as an illustration to understand this concept a bit better. So we have a tax liability of 5,000, non-refundable tax credit is 3,000, refundable tax credit 2,500. First, we'll reduce the non-refundable tax credit entirely, so to get the balance tax, and then we'll apply the refundable tax credit so that we can generate the refund. And the impact of the phase out, for example, eligible credit is 2,000, income exceeds the threshold, reduced tax credit is available 1,200 after the phased out. So key rules to remember is that order matters, and this is very important tax planning concept that non-refundable should be applied first, and then the refundable tax credit should be applied. Credit cannot exceed the tax liability of the non-refundable. Proper documentation is required for the calculation. The calculation of tax credit is not just about subtracting the amount, it allows to define sequence. Non-refundable tax credit reduce the tax first, followed by the refundable tax credit, they may generate the refund. Understanding this flow is critical for the accurate tax computation. So we'll move to the next slide. Okay. So though we have understood the concept of refundable versus non-refundable, let's do a kind of another deep dive here to understand it in bit detail now. Refundable, non-refundable tax credit is definition. They reduce the tax liability only up to zero. Key characteristics are that cannot be create a refund and benefit limited by the tax payable and often used as a mid income and the high income taxpayer. Example: lifetime learning credit (LLC) and child and the dependent care credit. So tax liability, for example, is 1,500, credit is 2,000, final tax is zero, and excess is lost. Refundable tax credit is definition reduce the tax liability and provide the refund. Key characteristics can result in the negative tax, highly beneficial for the lower income tax groups and act like a government payment. For example, earned income tax credit and the additional child tax credit. Tax liability 1,500, credit is 2,500, refund would generate for the 1,000. So we'll move to the next slide and look at some more concept on refundable versus non-refundable. So non-refundable can reduce the tax level to zero, reduce the tax to zero to the amount of the application. Refund beyond zero is not there. For refundable, it is there. Excess benefit is lost. Excess is refunded. So practical flow is that compute the tax liability, apply the non-refundable credit first, then apply the refundable credit to get the final tax or the refund, what the case may be. Strategic impact is non-refundable tax credit useful only if the tax liability exists. Planning required to avoid wastage. Refundable tax credit provide maximum benefit regardless of the tax liability, which is very important. So our order should be that we should first apply the non-refundable and then the refundable tax credit. So with this, we move to the next slide. Okay, now we are going to understand some of the common errors that is being committed by the taxpayers and understand some of the compliances risk. First of all, errors in the claiming the tax credit can lead to the disallowed credit, penalties and the interest and IRS audit. So we need to understand that we have to be very judicious and very accurate while claiming any of those tax credit. So common error in the tax credit is incorrect eligibility assessment. So claiming tax credit without meeting the eligibility assessment is one of the major area. Income threshold is another area that needs to be applied, and the dependence criteria. All these limits needs to be, all these things to be understood very clearly before we can claim any tax credit. Misinterpreting qualifying child dependence rule may lead to the unnecessary penalties and the interest. A double claiming of the dependent, same dependent claimed by the multiple taxpayer, common in divorced and separated parent. Incorrect income reporting, under-reporting of the income to qualify for the tax credit, EITC, etc. Claiming the ineligible expenses, education credits, including the non-qualified expenses, missing or invalid documentation, no receipt or the proof of the expense, missing required forms, invalid SSN number or the TN, social security number or the TIN number, tax identification number, filing status errors, using the incorrect filing status, claiming tax credit under MFS when not allowed. So all these are the some of the common errors, though it is not being intention, but these errors can lead to the penalties and the interest, and may also lead to some of the notices. So we'll move to the next slide and look at some of the compliance risks then. So key compliances risk is first is the IRS audit and the scrutiny, which means high tax credits like EITC and child tax credits. If being claimed, then obviously then it leads to some scrutiny by the department. Accuracy related penalties and the repayment of the excess credit refunds will lead to the penalties and the interest if they are not being done with the proper documentation. Uh, Credit this was temporary or the long-term ban from claiming certain credits like EITC ban for the reckless claim. Reputation and the operational risk for the firms, for taxpayers like BPO, loss of the tax credits, tax preparers and the for the tax preparers, reputation and operational risk, regulatory consequences are there. And then preventive measures and the best practices is just to make sure that validate the eligibility before calculation, maintain the complete documentation, cross-check everything before claiming the deduction. For dependency claim, please ensure that the proper dependent documentation are there. They have been proper rules are applied to claim the credit, and phased out rules are also been looked into so that lower credit is available for the higher income tax bracket. So tax credit, especially refundable ones, are heavy scrutinized by the IRS because even a small credit is a kind of a payback by the department. Even small errors can lead to the penalty or disqualification also. A strong validation documentation process is essential to claim the credit for these cases. So we'll discuss the common errors in the compliance. So let's move to the next slide. Okay. So we are going to talk about some of the recent changes and updates. So typically we know that when we're talking about the tax rules, tax credits, deductions, or the ways of earning income and how a particular income needs to be reported, all these are subject to the changes which is being done on annual basis by the various authorities. So we are talking about the changes which is being introduced recently. We're going to talk about those changes now. So key legislative updates for 2025 law changes. The one big beautiful bill act 2025 introduced one big beautiful act enhancement to the child tax credit and changes to the refundable provision, expansion of the certain business and the adoption credits. So child tax credit major changes increased to 2200 per child for 2025 and refundable portion is up to 1700 per child, which is the partially refundable. Phased out threshold is that 2 lakh for a single, 4 lakh for a married filing jointly. This is the phase out limit. Index for the inflation started 2026. So earned income tax credit updates increases maximum credit of 8046 for 2025, increase further to 8231 to 2026. Income threshold adjustment for the inflation and the continued focus on the low income support group. Adoption of tax credit enhancement, maximum credit increase from 17,280 2025 to 17,670 2026, and refundable portion increased to $5,000 plus approximately. Expanded support to the adoptive family. We'll move to the next slide and look at some of one other key changes or key benefits that has been introduced by one big beautiful big bill act 2025. Refundability and structural changes, greater emphasis on the partial refundable credit like child tax credit and American tax credit, and then the policy threshold increased cash benefit for lower income taxpayers. Inflation adjustment, which is like ongoing annual updates on the credit limits, the income threshold, and the phase out limits. And then faster refund process via a direct deposit mandatory shift from the paper checks, and EITC and ACTC refund typically released by March of 2026. So recent tax credit changes reflect a strong policy push towards supporting the families and the low income taxpayer through increased refundability and the higher credit limits. So with this, we'll largely come to the end of this chapter. We are going to look at the detailed example in the next slide. Okay, so we have come up with the detailed example to understand this concept in detail. So, filing status, we are taking single, earned income is 45,000, tax liability before credit is 4,500. Eligible tax credit is CTC of 2,000, which is partially refundable. Lifetime credit is 1,000, which is non-refundable. Step-by-step calculation. Initial tax liability is 4,500. Apply the non-refundable credit first. So lifetime credit is 1,000. So we'll reduce this credit to get the tax liability of 3,500. Then we'll apply the partial tax credit, which can be partially refundable, which is CTC. We'll reduce this to get the final tax liability of 1,500. Assuming the full CTC is using as a liability, apply the refundable credit. So we have earned income tax credit of 1,500. So remaining tax of 1,500 will be set off against EITC. So tax liability is 0. So in the alternate scenario, if we take the tax liability as 2,000, then we'll first apply the LLC, which is 1,000, remaining balance is to 1,000. Then we'll apply the CTC, which is 2,000. So 1,000 used to reduce the tax to 0, and the remaining 1,000 is refundable because this is partially refundable. And third, we'll have the EITC because this is fully refundable. So this will generate the total refund of 2,500. So this is how we have to use the benefit of both refundable, non-refundable, and partially refundable tax credit to get the maximum advantage so that we can get the refund from the department. So we'll move to the final slide and look at some of the key takeaways and synopsis of this chapter. So some of the key takeaways is that we need to understand the concept of the tax credit too, because this will help us to do the deductions from the tax liability that we pay. Type always matter because non-refundable tax credit is limited to the tax liability, refundable can generate the refund, and partially refundable is the combination of the both. The sequence is critical. We'll apply the non-refundable credit first, followed by the partially refundable, and finally the refundable tax credit. Eligibility is the foundation because if we are claiming the deduction without being eligibility, then definitely we are subjected to the penalties and the interest. So it is based on the income threshold, filing status, and the dependency rules. Error in the eligibility will lead to the credit disallowances. Impact of the income is phased out, so credit reduces as the income increases. Planning requires to maximize the benefit, and we have to make sure that we have a maintained valid SSN and TIN expenses proof and the required IRS forms. Non-compliances will lead to the penalties and interest and audits. Strategic importance helps in reducing the tax burden, improving the tax cash flow, and increasing the refund. So with this, we'll come to the end of this chapter. We'll finally move to the closing side and look at what we're going to come as a next chapter. Okay. So now that we have covered the different type of the tax credit, their calculation, eligibility, and the compliance aspect, one thing should be very clear that not all tax credits are the same, and their real value depend on how they are applied. But to truly understand their impact, we need to go beyond the theory and look at the real high impact credits and used by the taxpayer every day. And among all the individual tax credit, one of the most significant and the widely used is the child tax credit. So we are going to discuss about the child tax credit detail in the upcoming slide. So until then, thank you and goodbye. Please watch this video, share this video, and like our channel. Thank you.